This is kind of the middle of summer, which from an investment standpoint is referred to as negative seasonality. At least most of the time it's negative. It's part of the old mantra that most likely as an investor you've heard before, sell in May and go away. Wait until October and come back because the good news starts in October. And basically what's happened is people come back from vacation, they're through with getting their kids off to school, and they're back to work, and they quit spending money. Now they're paying attention to their investments, trying to recover from what they spent during the summer. My name is Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So the major thing that investors have been looking for is Federal Reserve Jerome Powell to announce that rate cuts were coming, which he almost did just last week.
Right.
So we had euphoria on Friday, and on Monday we had a hangover headache. And we're saying, did he really do that? I'm not sure. And even if he did say it, will he actually follow through? Because there have been so many suppositions about what the Fed was going to do that have not come to pass, and so much criticism of the Fed. He doesn't have a lot of credibility anymore about whether or not the Fed is following his direction, or if he's actually summarizing what the Fed is going to do.
And we're absolutely no longer in an atmosphere where we could do something logical like, well, let's sit back and wait and see what the Fed does. No. We got to take up bets well in advance. Are they going to finally cut rates or not? And in the last Fed speech, Chairman Powell was fairly neutral. He said that we may need to address where we are. That was enough for a lot of people to say, well, that's it. Rate cuts in. If we may need to address it, our policy position, then they're going to cut rates. But he went on to say that we are still completely data driven. No decision has been made, and we'll get there when we get there. So he may just be trying to save face. Like you said, Don, they've been wrong a long time here. They've been behind the curve for quite a while, according to many economists, and they're now, we think, finally going to have to at least begin to get back in line.
Well, one of the other comments that was watched closely by the market after the Jackson Hole speech was over was that he basically admitted that they were going to look at their models.
Yeah,
there's been a lot of argument. Their models are just way out of whack. They have they're too reliant on lagging data, and they're based on a Keynesian model, post World War II data, kind of looking over your shoulder. Things move slowly. The technology world doesn't move slowly anymore. If you blink, you can miss a turn.
And all of their methodology is steeped in academia. You can find the history of where all their metrics came from and why they're making their decisions, and you can see what it is they're doing. It's like what you said, Don, though. It's just that they are so antiquated that they're not moving at the speed that the data moves at today, and they're going to need to revamp that to be a little more in tune with the current metrics, where the market and the economy are now and where they're heading and what things mean in the future. They don't necessarily mean the same thing they did 50 years ago. It's not the same. And they're still kind of looking in the same old school academic view of the economy and what causes change in the economy.
Well, plus they're tracking data the old-fashioned way, the way we've always done it. They're picking up a telephone or they're sending out surveys, and businesses and consumers aren't responding to surveys anymore. So their data collection continues to shrink, where if you go online for trueflation.com, they're tracking digital transactions. So they're tracking what happens at Amazon and eBay and Priceline. I mean, they know today, what's actually happening today, this hour, and they're updating their inflation data, which is reporting about half of what the Fed says it is tracking, because they're looking so far over their shoulder, they're out of touch with today. That's a problem. It's one of the reasons that their transitory inflation situation was totally disconnected from fact.
Right.
And
Right. And
now, how do you bail yourself out? Try to save face. Bottom line here is that whether they do it in September, rate cuts are coming. There is, it's
yeah,
extremely difficult to suggest that they're going to maintain rates with inflation coming down. The only argument for maintaining rates where they are is that the weak labor market isn't weak. Well, why is that? Because that data is coming in, but it has the same data collection problem because of the processes they use to collect the data.
absolutely.
And that is that the rate of hiring has slowed doesn't mean that companies don't need jobs. It may well be that hiring has slowed because they're spending more money on robotics. When you're looking at having to hire somebody with minimum wage for somebody who knows nothing about working at
Right.
$20 or greater in some areas,
Yep.
or hiring a robot that doesn't get sick, that doesn't need health care, that doesn't need lunch break, that can work 24/7. That, there's a capital expense and then there's some maintenance of robots. Robots doesn't mean that there won't be people hired. They're going to be hired for different jobs, some of which will be to maintain the robots that are doing the work.
Sure. And those are inputs that didn't exist before. So the Fed is not really looking at that, and they're saying, they're always going to wait. We're going to wait, and we're going to try to be more sure about what's going on. And the Fed does not operate in a vacuum. They hear everything we do, and they know the things that other people are watching. And as much as they like to claim they're not a political animal, they are to some degree. And when you've gotten it wrong, you want to get it right. So you don't want to take a step out too soon and be on the wrong side. And so in their opinion, they're hitting this square on. They think they're right in the right space, and they can start cutting rates probably in September. The market is suggesting, the market-based metrics are suggesting there's about an 85% chance of a rate cut in September. So the markets are relatively sure there's going to be a rate cut, and then there's the economists saying once they start, it's probably going to be 25 basis points per meeting until they get past 1%. So 4 in a row, probably we're going to have rate cuts. That's that's the way that that is being called right now. And unless something drastic happens, there's probably enough economic data to warrant those cuts and not get in the way and leave the Fed plenty of room to say, yeah, we're being careful, and yes, we're watching what's going on, but it's time to make an adjustment in our model. So right now it appears that is what's going to happen.
But that does not mean you, as a bond investor, a fixed income investor, you should not be concerned because there are issues that are not being addressed in the general market. One of the things that has happened that's unexpected, even though rates are expected to come down, which should be a benefit for bond investors, because
Right.
as rates fall, the value of your bond portfolio rises. And frankly, it's about time. Bonds have been in a bear market for 5 years. Nobody wants to talk about that, but the safety portion of your portfolio has been in the tank for five
Not too
years.
safe. Yep.
It's
Yep.
about time for rates to fall to revive that safety value. But the problem is that many long term investors are expecting the long end of the yield curve to drop with the rate reduction by the Fed, and that is not happening. The long term investor is actually demanding more return. There are fewer and fewer bonds available on the long end, so that's driving up prices as buyers come to the market. The Fed doesn't control that. The Fed controls the short end, the overnight rate for banks, and so that's going to have the most direct contact on the 1 to 3 month Treasury bills and short-term corporate money. But it was going to have the least effect on mortgages, which
Right.
means that even though we're going to see lower rates, where we probably are in the mortgage rate business is somewhere close to the long-term average for 30-year mortgage in the 6+ range. And right now, home builders aren't expecting that. Investors are waiting for rates to come back down to the 5 or even 4. It's it's Goldilocks to think you're going to see a
Right.
3% mortgage again. Uh, that
Absolutely right.
that's a once in a lifetime opportunity that some of us were able to capture. Have some clients that were in the twos, and Amazon, I think, bought they did a 40-year bond offering, I believe it was, at 2.25, 2 1/8, at the very low of rates back during COVID. And I'm saying, what on earth are they doing that for? I mean, this doesn't make any sense. Well, it makes a lot of sense in retrospect.
Right.
They gathered up a ton of money to use for business expansion and for buying back their stock now that the stock is higher. So just because rates are going to come down and likely to come down throughout next year, the opportunity lies in corporate America's stock holdings. Because as interest rates come down, the operating expense of paying off debt or being able to borrow for business expansion at a lower cost of money gives a better bottom line. So the
Sure.
real money that lies ahead with lower interest rates is not on the fixed income side, it's in the corporate stock side. And
And
that's where,
there's been questions about is the Fed going to be willing to cut rates when the stock markets are at or near all-time highs? Are they going to cut rates when the markets don't need any support at all? And the answer is yeah, they've done it before, and it works just as well as if there's an issue. We don't need anybody to save markets right now. Everything's doing quite well. But historically speaking, when the Fed cuts rates and markets are very high already, they tend to take another leg up. So they respond quite well to the rate cut, like you just said, Tom, because all those stocks are now going to start doing better, and everyone's expenses for borrowing money to expand or buy back their own stock goes down, not up. So it's still going to be a good thing. And I don't think the Fed's concerned at all about cutting rates because of the market. I think they're much more concerned about the uncertainty of inflation and the uncertainty of, they keep talking about the uncertainty of the effects of the tariffs, even though the tariffs dissolve as soon as, the countries get together and talk things over. So I'm not sure there's going to be any long-term effect there that's going to be highly detrimental. So I don't really think that's an issue, but I'm not the Fed, and I don't get to say I don't think that's not an issue. They have to deal with it, and so those are some of the things that are on their plate. But none of those things say, well, that's it. We can't cut rates. There's something in the way, and that's why the odds of a rate cut have continued to increase.
so the lag effect of rate cuts is really strong. And you just alluded to this. The Carson Group and several other groups have done back data mining, if you will, looking at history. What happens when the market, when it's at highs and the Fed has cut rates under previous administrations. And if you go out 1 or 2 years, and I think one of them went out 5 years, the market continues to move up.
Yep.
The Fed is dealing with other monetary issues, not necessarily the market, but when you cut the cost of business, profits improve, it attracts capital. Yep. It makes it easier to borrow money for expansion. It makes it easier just to buy new equipment. It makes it easier to make payroll. And all of that correlates to higher stock prices. So more investors get on board. We are not at a bubble point as far as even AI is concerned yet. We simply
Correct.
have not had enough speculation in the market to have the correlations between now and the tech bubble in 2001 to have any real meaning yet. So this summer, because we're still in seasonality drawdown period, you're going to get a lot more headlines about this is bubble territory. Valuations don't make any sense. Valuations are extended, but they're always extended when you have innovation going on. Companies making innovation, whether it was railroads back in the 1800s, whether we're dealing with the development of automobiles. Every time you have major innovation, valuations get extended because people are looking forward to the massive change it's going to make in the way the economy runs and the improvement in our personal lifestyles. Do not be discouraged by that. Look at what the companies are doing, offering, and the liquidity around what you're investing in. Those are the important drivers. Do not be over diversified. Warren Buffett said diversification is for people who don't know what they're doing. If you're paying attention to where the market is going and where the liquidity is leading, that is where you should be focused on it. Diversification, will damage your returns, but you got to know what you're doing. If you need help and you want to talk to us, give us a call, send us an email. Free time online with us, one-on-one with you. Thanks for being with us. Subscribe to our podcast. We've got more coming. Have a great day. Thanks for being with us. Come back again.